In this particular video, we will discuss about judgment under uncertainty. Judgment under uncertainty involves making decisions without knowing all variables or outcomes. For example, investing in the stock market when uncertainty plays a significant role. How relevant is judgment under uncertainty in finance? Uncertainty in market movements, interest rates, and economic indicators affect investor behavior. So, when you're not really certain of what's happening around you and you still make any investment decisions, then it is called judgment under uncertainty. Heuristics in decision making. There are several judgments under uncertainty, the first being heuristics. Heuristics are mental shortcuts or rules of thumb used to make quick decisions under uncertainty. There are different types of heuristics. Availability heuristics, where you rely on immediate examples that come to your mind. You rely on what is available in your mind. Second is representativeness heuristics, where you judge the probability of an event by comparing it to an existing prototype. You consider an existing prototype to be a representative of a probable event. The third is anchoring heuristic, where your decisions are based on initial information or number. You're strongly anchored to what happens in the past, and you take any decision based on that past happening. There are different common cognitive biases. Cognitive biases are systematic errors in thinking that affect decisions and judgments. The first is overconfidence bias, where investors overestimate their knowledge on predictive ability. The second is confirmation bias, where we seek out information that confirms pre existing beliefs. The third is hindsight bias, where we believe that after an event has occurred, that it was already predictable and it is already under our control. Prospect theory. Prospect theory, developed by Daniel Kahneman and Amos Tversky. This theory describes how people choose between probabilistic alternatives involving risk. The key concepts are loss aversion. People fear losses more than they value gains. Decisions are influenced by how choices are presented. People evaluate outcomes relative to a reference point rather than absolute terms. Impact of emotions on decision making. Emotions like fear, greed, and euphoria can heavily influence financial decisions. Behavioral finance and emotion. Fear leads to panic selling during market downturns. Greed can drive speculative bubbles. Euphoria or excessive happiness, on the other hand, may cause irrational exuberance, leading to overvaluation of assets. Behavioral biases in investment decision making. There are several behavioral biases when it comes to investment decision. The first is herd behavior. Investors tend to follow the crowd, which can lead to the amplification of market trends, like in the dot-com bubble. Mental accounting. Investors treat money differently based on subjective criteria, which can lead to irrational investment decisions. The third, self-attribution bias. Investors attribute success to their skill and failures to external factors, leading to overconfidence. Market anomalies. Market anomalies are patterns in stock returns that cannot be explained by traditional financial theories. For example, the January effect. Stocks tend to perform better in January due to investor behavior. The second, momentum effect. Stocks that have performed well in the past continue to do so due to investor herding. The third, post earnings announcement drift. Stock prices slowly adjust to earnings news, reflecting investor underreaction. Mitigating biases in decision making. The first is through awareness. Recognizing biases is the first step in mitigating their impact. The second is de-biasing techniques, pre-commitment, making investment decisions before emotions come into play. Diversification, reducing risk by spreading investments across various assets. Consulting objective data, relying on data and analysis rather than intuition. Implications for finance professionals. All these concepts would help us understand behavioral biases and how they can improve portfolio management and risk assessment. Financial professionals can use behavioral insights to better communicate with and advise clients. Awareness of behavioral finance can lead to more accurate predictions of market trends and investment behavior. Throughout this presentation, we've explored how judgment under uncertainty, shaped by psychological factors, plays a crucial role in financial decision making. Key behavioral concepts such as heuristics, Cognitive biases and prospect theory offer insights into why investors often make irrational choices. The emotional influences and biases discussed not only explain market anomalies but also highlight the importance of recognizing and mitigating these biases in financial strategies. Hope this video was useful. I'll catch you soon with another interesting video. Thank you.